Hello everyone. In this video, we're going to go through the process of building up our valuation model. I'm going to assume that we have our forecast of sales growth, operating profitability, asset turnover, capital structure, and cost of capital. You can get our starting point using this file on Moodle. Now, here are the steps that we're going to go through. First, we're going to generate our condensed income statement and balance sheet based on our forecast. Secondly, we're going to determine our free cash flow to equity holders and free cash flow to all capital providers. Third, we'll turn our forecasts of free cash flows into an equity valuation model. Fourth, we'll generate our forecasts of residual income or abnormal earnings and then put those into a valuation model. Finally, we will check that our estimate of value is the same for both the free cash flows and the residual income models. Then we can see what happens if we change our assumptions, see the impact that they have on our valuation. Now, the first thing to note that the forecast that we've got on this spreadsheet are using start of year balance sheet information. So our start of year balances are, of course, the prior year closing or end of year balances. What it does mean is that we just need to be careful when we're lining up the income statement and balance sheet amounts. We can think of this as our forecast being based on the level of investment as reflected in the balance sheet that is required to generate the sales that we're forecasting. So that's reflected in our first year forecast amounts. So, okay, so let's get started. I'm assuming that we've got all of our forecasts from row 6 through to 17, which is going to be generating the revenue forecast that we have for Kathmandu that we see overall in row 26 for Kathmandu, row 28 for Oboz, row 32 for Rip Curl. We get our total revenue all lined up in row 37. That gives us our implied revenue growth rate or sales growth rate in 38. We've then got our sales growth, our operating profit margins, our asset turnover ratios, our cost of debt, and start of year debt to capital ratios. I've got these cells, the cells that you see here in column F, I've highlighted, because even though they're under forecast, part of the equation here, and in particular the balance sheet component of the equation, already exists. So once we have sales, our forecast for sales in 2021, we'll have our ratios for the start of year operating working capital and start of year net operating long-term assets. We've also got our start of year debt to capital ratio. So let's just generate our sales forecast and the remainder of the income statement first, then we can see how that impacts on these balance sheet amounts here. Okay, so I'm going to go down to sales for 2021. Sales for 2021 is going to equal sales in 2020 multiplied by 1 times my forecast growth rate for 2021. 1 plus the forecast growth rate for 2021. 947,612 is the number that we should be getting there. Our net operating profit after tax is going to be sales for the year multiplied by the profit margin that we're forecasting for the year. The net interest expense after tax is going to be a function of 2 things. 1, our after-tax cost of interest, and secondly, the net debt that we're forecasting to have at the start of the year. Now, that should give us our income statement for the year. Now, I'm just going to copy this cell across, but in short, it's net operating profit after tax less interest expense after tax. So let's just do that one afresh. Minus 47,193. Yes, that's a bit of a jump from 8879, but this is our coronavirus year. Okay, now that we have our sales forecast for the year, we can go back and create our working capital or our asset turnover ratios here. So start of year working capital divided by sales is going to be the end of the previous year working capital divided by the sales that we forecast this year. And that's 5.8%. We'll do the same thing for the long-term assets relative to sales. 733 divided by the sales that we're forecasting, 77%. Finally, we can get the start of year debt to capital ratio. Again, that already exists. We've got net debt divided by net capital, 1.2%. Okay, we can easily get our income statements for the year, except we haven't got the net interest expense after tax figures auto-filling. The reason being is that we need our net debt figure. So let's go and create the 2022 balance sheet numbers. We'll do it like this. The beginning operating capital that we're forecasting to generate our 2022 sales is going to be 2022 sales multiplied by 2022 start of year operating working capital relative to sales. 50,157 is our amount. Again, our long-term assets is going to be sales multiplied by our long-term assets ratio. We'll add those two things up. That will get us our net operating assets for the year. We know that the net operating assets are going to be funded by either debt or equity. So we'll take debt is going to be the net operating assets multiplied by debt to capital ratio. The difference is going to be equity. And by construction, we know that debt plus equity is going to have to equal net operating assets. So we need row 55, row 58 have to be the same number. Now that we've got those, again, we can drag those out. 2026 is our terminal year, but for both the free cash flow model and the residual income model, we're going to need the end of year balance sheets for 2026. So to get that, I'm going to need 2027 start of year balance sheet. That's why I'll extend out and I will get sales in 2027. So sales in 27 I'll work out, and I'll do that so that I can get the balance sheet figures for 2027. And I'll scroll that across so that we can see what we're doing. Now that I have the balance sheet amounts for 2027, I can select all of these cells and I'll drag that across. So we now have the balance sheet for the end of our 2026 forecasting period, the income statement for the 2026 forecasting period, and we have our condensed balance sheet and our condensed income statement over our forecasting period. So let's turn that into first our forecasts of free cash flow to equity. So if I scroll down, we know that free cash flow to equity is going to be net income, less the change in working capital over the course of the year, less the change in net long-term operating assets over the year, plus any change in net debt over the year. So net income, I've just calculated. The change in working capital during the year is going to be the end of this year minus the start of this year. The end of this year will be in cell G53. So G53 less the cell F53, which is our start of year value. So remember that because we're using beginning of year balance sheet amounts, I need to go forward a year to pick up the change in balance sheet amounts over the course of the year. I'll do the same thing for long-term assets. So end of year long-term assets minus start of year long-term assets. And the same again for net debt. End of year net debt minus start of year net debt. That'll generate our forecast of free cash flow to equity. So net income minus change in working capital minus change in long-term assets plus change in net debt. So net income minus change in long-term assets plus change in net debt. That's the formula that I want. I can now get our free cash flow to equity forecast for my year-by-year forecasting period and my terminal year 2026. And so year-by-year forecasting period and my terminal year 2026 there. And we've got those numbers there. You should be able, hopefully you'll be able to match those up. Now, I'm going to assume that our cost of equity capital is 8%. So assuming cost of equity of 8%, let's hide this column simply so you can see what's on the spreadsheet as I'm talking away here. Here's what we need to do. For the free cash flow to equity model, our DCF model, I need a couple of things. First of all, I need my free cash flow forecast, and that's what I've just calculated. I need the discount rate or the present value factor based on 8%. I'll then work out the present value of the year-by-year forecast. Then I'll work out the present value of all free cash flows to equity beyond the 5-year forecasting window. That is 2026 and beyond. Okay, first up, free cash flow 2021 is the number that I've just calculated, 138,224. The discount factor that I'm going to use, the discount factor is going to be, this is year one. This is why I've got the 1, 2, 3, 4, 5, 6 up above here, because I'm going to use that in my discount formula. Equals 1 divided by 1 plus r to the power of n. 1 plus r, and because I'm going to be copying this cell over, I'm going to hard code that. Let's see if I get the function right here on this keyboard. 1 plus r, and I didn't get that right, so I'll manually put those dollar signs in. 1 plus r to the power of number 1. And 0.93 I know is the discount rate. Excuse me. I multiply those two things together and I'll get the present value of the free cash flow to equity. Equals free cash flow multiplied by discount rate. I can then do that, drag that across for the first 5 years. That gives me my first 5 years worth of free cash flows. I'm not going to do that for the terminal year or the year 6 free cash flow because that's going to form my annuity or my final year perpetuity. So first up, I'm going to take the value or the sum of those present values that I've just calculated. So I'll add up 1, 2, 3, 4, those 5 present values that I've just calculated. To that, I then need the present value of all free cash flow that occurs beyond year 5. Let's do that in 2 steps. First, I'm going to work out what the value of the free cash flows beyond year 5 would be expressed in future dollars. So I'm not going to discount that back to dollars today. So using our perpetuity or our growing perpetuity formula, it's going to be the free cash flow divided by R minus G, divided by 8% is our cost of capital, less G, which is going to be sales growth. So that's the future value of the free cash flows beyond year 5. I then need to get those into present value. I'll do so this way, equals the future annuity value multiplied by, remember that it's N minus 1 or T minus 1 is the appropriate discount factor. We do this because that perpetuity calculation has already discounted by a year for us. Now, I'll add up the sum of equity from years 1 to 5. I'll add to that the sum of equity or the sum of the free cash flows beyond year 5. That will give you the total value of equity. Now, I've already loaded in the number of shares. Estimated share price is value of equity divided by number of shares. Now, we can use the same set of forecast and the same starting point for our residual income or our abnormal earnings-based model. And what we are hoping to see is that it will give us the same resulting end value. Let's see how this works. The residual income model says we'll start off by calculating this idea of residual income or taking into account the charge for equity capital. So residual income is actual income less the required capital or the equity charge or capital charge. So net income we've previously calculated, 47,193. Then if we go down and we're looking at this charge for equity capital, it's going to be the discount rate. And again, I need to hard code that discount rate multiplied by start of year book value of equity. That start of year book value of equity. Let's scroll back up. 2021 start of year book value of equity. That gives us our residual income or our abnormal income is actual income less this capital charge. So in the first year, that amount's actually a loss. So can a company earn negative residual income? Yes, it can. All that means is that that year, the managers aren't creating value from the perspective of the shareholders. So again, we need to discount these residual income amounts into dollars today. I'm going to use the same discount rate because it's still the cost of equity capital because we're valuing the payoffs that the shareholders receive. So the present value of residual income will be the residual income amount that we've just calculated multiplied by our discount rate. And like we did for the free cash flow model, I'm going to grab those cells, copy those across for the first 5 years. That will get me the present value of residual income for years 1 to 5. I then, matching what we were doing previously, I then need to get the value and then the present value of residual income beyond year 5. So to do that, I still need residual income in year 6. That's our starting point. I'll do this the same way that we did the free cash flow up above. Let me just move the screen over so you can follow what I'm doing. So the future value of residual income, again, this is our growing perpetuity. It's residual income divided by R minus G. R is still 8%. We've still got the same growth rate. Let's scroll our way back up and it's sales growth, the 2.7. So that's the future value of our residual income beyond year 5. I then need to get that into dollars today. Equals future value. Once again, I'm going to multiply it by the year 5 discount rate. So that gives me the second component that I'm interested in, present value of residual income beyond year 5. I still need the first component, the sum of the present values of residual income in years 1 to 5. So sum of the present value of residual income, years 1 to 5. The final component that I need in our residual earnings model is going to be the start of year book value of equity. Let's scroll back up to our forecast balance sheet. And here we have it. Cell F57, Start of year shareholders' equity. So what do I now see? I now get the estimated value of equity is going to be years 1 to 5, residual income beyond year 5, and start of year book value of equity. And happily, I know that the value of equity using the residual income model is the same as the value of equity using the free cash flow model. And that's what we're hoping to see. So that's one way of checking that you've got these valuation models set up correctly. The next thing you want to do just to check is we can make sure that if we change our cost of capital assumption, let's just change this to 9%. The value per share for free cash flows and for residual income should still be the same. Let's see what happens. $1.73 for free cash flows, $1.73 for residual income. So we're confident that we've got the spreadsheet or the mechanics of the spreadsheet set up there correctly. So that's how we go from a set of forecasts through to creating our condensed balance sheet, our condensed income statement, calculating our free cash flows, using those forecasts of free cash flows to value the equity, calculating our residual income, using the residual income to generate our cost of equity. Again, as I've been stressing, both of the models should give you the same value of equity because both are using the same starting point and the same set of forecasts. I hope you enjoyed this video. Click like and subscribe.